Hello and welcome. In this video, we will learn what Vega is and also we will learn how it affects the price of an option. Okay. We have learnt about the factors affecting the option price and we are learning about the option Greeks. All these are covered in the previous video. Vega and rho are remaining. So we will cover both in this video. Okay. Now what is Vega? We will try to understand this. Vega of an option measures the rate of change of options premium for unit percentage change in implied volatility. Okay, so this is the definition. Now, let me first explain what volatility is and then explain what implied volatility is and then explain you how Vega is used to calculate the premium. Okay. Now, at your home, you have refrigerator and you have TV, correct? Now, both are connected to the power supply through a voltage stabilizer, right? Now, what is the use of this voltage stabilizer? It is to stabilize the voltage. Now, when do we need this stabilizer? We need this mainly in the rainy season, correct? In the winter season, in summer, the voltage fluctuation will not be much. But in rainy season, or at least at my place, in rainy season, the voltage fluctuates too much from the normal value. Okay? This fluctuation of the voltage from normal value is called as volatility. Okay? And to correct this fluctuation, we use stabilizer. Okay? We use stabilizer. Now coming to our stock, there is a normal average price. Okay, there is a normal price at which the option or stock is trading, not option, stock is trading. The stock may fluctuate up and down. Okay, it will be fluctuating, it will be going up and down. But if it goes up too much, comes down too much, goes up too much at a different rate or quickly, comes down too much quickly, then we call that stock as volatile. Okay. Now this will happen due to many reasons. We will see why it happens later. But just know that if the stock fluctuates too much, then it is called volatile. Okay, that is volatility. Too much fluctuation from the normal price is called as volatility. Now, we need to learn statistics to learn what Vega is, but I am not going to go there. So, I won't be giving you the exact meaning of Vega. I just want you to know what it is. Okay. Now, if you take this example, this point may be last year. This point may be this year. Even though there is no price change in 1 year, the stock may have been volatile. Okay, it might have been volatile. We do not know that. Alright, by just looking at this, we cannot say if the stock is or stock was volatile or not. It may have been volatile. So it fluctuated back, fluctuated, and then today it is 100. So even though it was at 100 last year, today 100 this year, it doesn't mean that it was not volatile. It might have been volatile, but what we are seeing today is the same value. Okay, even though it is at same value, it can be volatile or it could have been volatile. Okay. Now, volatility or volatile means it fluctuates a lot, that's all. Okay. Now, implied volatility means it is the market's opinion of the stock's potential move in the future. Meaning, how much will the stock move up and down or fluctuate in the future according to the market. That is called as implied volatility. Okay. If you look at past data, if you look at past 1 week data or 1 month data or 1 year data, you will see how much the price has fluctuated. Okay. What is the fluctuation? Now, when I say fluctuation, it is not only in one side. It is in both sides. Okay. Up and down, both. Okay. So, we can get that data. Historical data we can get. Okay. We can come to know how much did it fluctuate over the period of 1 week or 1 month or 1 year. But that is not we are concerned about. How much will it fluctuate in the future? Okay. What is our opinion about the stock's fluctuation? That is called as implied volatility. Okay. And the market's opinion of the stock's fluctuation depends on news, event, psychology and historical data. Okay. News. It may be a good news, it may be a bad news. Company may be releasing their profit or loss statement next week. Okay. Or next month. So, how much may it fluctuate next month? So, market's opinion depends on that. The company may be venturing into a new sector next month. So, according to that, there will be an opinion. So, that also affects the implied volatility. Next, the events. If there are any unforeseen events, for example, there was Corona, the stock prices fluctuated a lot, volatility increased. Okay, there may be war or some other event happening, unforeseen event, that also affects the market's opinion. Human psychology. Now, this is also interdependent on the event. If there is a bad event happening, then the psychology of the people trading will not be good. Everyone will sell the stock. There will be greed, there will be fear, and so on. This also affects the market's opinion. And the historical data. Market, it respects historical data and it also depends on these. Okay, historical data means how much did the stock fluctuate over the period of last 1 month or year. So basically, implied volatility means how much will the stock fluctuate in the future according to the market's opinion. Okay. Now this implied volatility is used in the calculation of premium. Okay. Let me take an example and show you the calculation. Alright, almost correct calculation. I'm not going to say perfect calculation because what I have been teaching you is what you need to know as of now. That's all. Okay. We have not learnt mathematics. We have not used any formulas. We have not learnt any statistics to calculate all the premium. Okay. If you want to do that accurately, you need to learn all those things, which is not required according to me at least. So, I am teaching you almost correct concept. Okay. Alright. So, I am in Sensible platform and in the settings and in Greek's view, I have turned on IV and Vega. Okay. IV and Vega. Rest everything is turned off. Now, let me zoom in. So that you can see better. Okay. Yeah. So, 43,700 is at the money. By the end of today's trading session, this was at the money. Okay. Now I have turned off per lot here. So you can see LTP, last traded price or premium for this strike price. And you can see Vega is 16 for IV value of Tolu. Alright, for IV value of Tolu, Vega is 16. Now what this means is, if this IV changes by 1%, okay, if this IV changes by 1%, meaning if it goes from 12.0 to 13.0, then this will increase by 16. The LTP will increase by 16 rupees. That is what this means. Okay. So 215.20 will become 231.20 when the IV changes from 12 to 13. Okay. Now, if it reduces or decreases by 1%, meaning if it changes from 12.0 to 11.0, then this LTP will decrease by 16. This LTP will decrease by 16. Okay. So that is what this Vega means. You can click on the question mark here and see the explanation given by Sensible. Alright, you can do this. Now basically, this Vega will be highest for at the money. Okay, this is highest for at the money. So here you can see it decreases, here also you can see it decreases. Okay, and this Vega value keeps reducing as the expiry nears. Okay, as we go near to the expiry, the Vega value keeps decreasing. Okay. Now, what I mean by decreasing is, even if this stays the same, even if this doesn't change to 13 or 11, this keeps decreasing as we near to the expiry. Okay. Next, Vega is the effect of IV. Vega and volatility are not the same. Okay, Vega is the effect of volatility. Both are different. I told you what volatility is, correct? Yes. Now, the question comes, why does the premium increase by Vega value when the volatility, implied volatility, increases or decreases? Okay, if it increases, this value increases. If it decreases to 11, this value decreases. Why is it so? Now think of it like this. Let us say you have bought at the money option. Okay, now when we say volatility is more, what does it mean? Then the chances of the price moving way too down or way too up is more, correct? Now see, you are an option buyer. Let us say you have bought this. Let us say you have bought put option. Okay, let us say you have bought put option. And now, if the volatility is more, the price movement will be more. And let us say the price moves to this. Okay, this is at the money. This was at the money when you have bought the option. After you bought the option, let us say price moved to this. That means, as a put option buyer, you are earning a lot of money. You are earning a lot of money due to the volatility. Volatility, what is volatility? Severe movement, up and down movement, correct? Severe up and down movement. Now, due to down movement, you as an option buyer have earned more, correct? Now, when the option buyer earns more, who loses more? It is the option seller, correct? So if buyer earns more, seller loses more. So what the seller says is, see, the volatility is high, so the chances of you the buyer, winning is more. The chances of me, the seller, losing is more. And since the chance of me losing is more, I want higher premium or a high premium. Okay, I want more premium. That is why the premium increases when volatility increases. Okay, same goes for call option too. Let us say you have bought this strike price call option, and let us say due to the volatility the price moves up severely. Okay, let us say the price goes to this point, and since you are a buyer and since the price move is a lot, you are earning a lot, correct? And if buyer earns a lot, seller loses a lot. And since the seller loses a lot, he asks for more premium. Okay, and that is why when the volatility increases, the LTP increases. Same goes for opposite side too. When the volatility decreases, what does it mean? There is no severe movement. There is no severe movement, up and down movement. When there is no severe up and down movement, the buyer of the option, whether it may be call or put, will not earn more. So the seller will be earning more here. And since the seller will be earning more here, he doesn't ask for more premium. So the premium value reduces. Since the risk for buyer is more here, seller says or buyer says, since the risk is more for me, I will not pay higher premium. So the seller says, since the risk is less here, give me less premium. Okay, so that is why the premium value decreases or reduces when the IV value reduces. Alright, so I hope this is clear. So Vega value tells you how much the premium will increase by when the IV value changes by 1%. Alright, I hope it is clear. So here also you can see the Vega values. Okay. So the final and the least important option Greeks is rho. Okay. I am not going to explain much about rho because I have already explained the effect of interest rate on the premium of option. Okay. In one of my older videos, I have explained how interest rate affects the premium. Okay, so not much left to explain here. Basically, what rho is, what it tells is, it tells us how much the premium will change if the risk-free interest rate changes by 1%. Okay, how much the premium will change. Premium will change means either positive or negative, meaning premium will increase or decrease if the risk-free interest rate increases or decreases by 1%. Okay. Now, when we say risk-free interest rate, it is mainly in government bonds or treasury bills. Alright. So, when this changes by 1%, either in positive direction or in negative direction, how much the premium will change. That is what rho tells us. Okay. Now it is least important because the interest rates do not change by a significant amount. Okay, and it also does not change every now and then. Okay, so this is why this is of lesser importance of all the 5 Greeks. Okay, and as I said once again, this is calculated once again by formula. Everything is calculated by using formulas, using computers, and we don't have to do them manually. Alright. Now, this is about the option Greeks. You do not have to know any of the option Greeks to learn trading. Okay. But it is good to know what they are. That is why I have taught you about the option Greeks. Okay. So if you have not understood any of the option Greeks, do not worry, just keep moving further. Alright. So that's it for this video. I'll see you in the next video. Till then, take care and thank you for watching.